is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Robert Tucci, who is a managing director of Texas Halo Fund, with 4 funds behind the Texas Halo Fund based in Houston, Texas. Robert has spent his career working where life sciences, technology, and capital meet, backing early-stage companies with potential to transform entire industries. He served on the boards of companies like Adient Medical and Dusol Therapeutics, and for 5 years he was the life sciences chair at the Houston Angel Network, helping to shape the innovation ecosystem in one of the most dynamic healthcare regions in the U.S. Robert, thank you for joining us.
Good morning.
Great. So where are you calling from today?
I am in Houston, Texas.
Great. Thanks. Let's talk more about the Texas Halo Fund. Can you tell us about the investment thesis? What kind of companies and founders fit best, and how is this thesis evolving over the last 1 to 2 years?
Sure. Well, Halo was founded in 2012. It was actually a spin-out from the Houston Angel Network. While we were involved in the Houston Angel Network, which I was involved with until 2017, we realized that most angels don't make money. And there were several reasons for that. And one of them is that they miss the portfolio effect. Most angels are not able to invest up to 20 or 30 different deals. And so they miss out on the portfolio effect. We set up the fund to provide that initially for our fellow, angels at the Houston Angel Network, but really for anybody else. And then from there, it morphed into what ultimately we became in Halo 4.
Great. So tell us what fundable looks like today. What are the 2 or 3 signals that you look for that says this is a good deal that's investable, or tells you it's not yet ready for a first review?
Sure. Well, one has to differentiate the many different sectors and subsectors of investments. My focus has been life science. And one of the characteristics of life science is that they tend to be longer term, longer duration. And that often makes it a harder sell. On the other hand, software deals tend to be quite quick and quite short. And then there's things like fintech and ag tech and consumer products, which can be in the middle. So it really varies by what sector. But I would say that at this point in time, there's a lot of money that's just sitting on the sidelines. And part of that perhaps is due to the chaos we see out of Washington, the uncertainty, et cetera. And whenever there's uncertainty, there's perceived to be an increase in risk by investors. Understandable. We're not seeing that in the stock market, but I think we're seeing that in private equity and venture, where the risks are much higher. And so I think that one of the things that investors would be looking for now more than ever would be deals that have been de-risked and perhaps deals that are shorter term, that have a quicker return and therefore have a lower perceived level of risk. So those would be some comments I would make there.
Sure. So let's talk about your diligence process. How does the Texas Halo Fund evaluate the opportunities from initial screening to close? What do you find is the most common failure points in these deals?
A lot of questions there. So once again, it varies by what subsector you're in. So if you're doing digital, you want to be concerned about whether there's competitors lurking in the shadows, et cetera. And you want to make sure that you can get something quick to market, because so much in digital is buying market share very quickly. Because there's no real barriers to entry, you can have competitors very quickly. The other side of the coin, on life science, where you have, for example, FDA approval, you have barriers to entry, and so that creates a different dynamic, if you will.
Cool. So in the life science space, we don't have revenue. So what do you use to track traction for the company? How do you know they're making progress?
Sure, very, very much so. Well, we're in life science, well, divided into 2, regulated and unregulated. So over-the-counter things which don't require FDA approval or only maybe minimally FDA clearance, it can almost be like a consumer product. We have a couple that are in Walgreens and CVS now. And those we do have to look at revenue, the cost to acquire a new customer. Customer acquisition cost is very important, as well as distribution and the market share. On the regulated side, we historically, if you go back 10 years or so, there were quite a few not digital, but devices that were taken out, maybe after the second phase of FDA studies. So FDA studies are in three phases: phase 1, 2, and 3, and then hopefully you have approval. Some companies were being taken out after the second phase of studies before FDA approval had been received. What we've seen over the last 10 years has been a real change. The acquisitions, the exits are not happening after phase 2, only very rarely. We're seeing those after phase 3. And then in addition to that, we're seeing that companies are saying, great, you have FDA approval. Now enter the market and prove market feasibility. And so then that is causing an extension of the time period until exit, but also, commercialization as a whole nother level of risk, particularly for startups that don't have that particular experience. And then, of course, that leads also to additional dilution where you have to spend money to commercialize, et cetera. So those are some of the differences.
So one of the key issues I hear from founders is valuation. How do we set valuation? How do you think about valuation in terms and creating a round that sets the founders up to win the next raise?
Well, valuation is, in the most basic sense, it's whatever investors will put money in for. It's that simple. Sometimes it's a rude awakening for people that without experience in this area. They think their innovation's worth X, and investors think it's worth X divided by 4. But it's whatever the investors will invest in. What was the second part of your question? Could you just repeat it?
Well, setting up terms that,
Oh, yeah. Okay. Yes.
and doing this in a way that, sets the founders to win the next raise. I
Sure.
sometimes find they overvalue one, but then they're very challenged in getting the next round.
Yeah, that's a real danger point. The company needs to be able to have money in the bank at all times. Otherwise, the founders, the very lean staff of a startup they're spending all their time trying to raise money, and that's counterproductive, really. So I guess what we want to see is that you always want to see when you have progressive raises, successive raises, you want to see the valuation going up, but you don't ever want it to go up too much, such that when the subsequent raise comes in, it's flat or potentially even down. So you really want to avoid down rounds. And so it's better to increase the valuation, maybe a little on the slower side, give investors a good deal as they would perceive it, but keep money in the bank, et cetera, because one of the real hidden costs of a startup is wasted time. And if you're spending all your time trying to raise money and not advancing the company, that's really counterproductive. And so sometimes I see companies that do overvalue rounds, and they have to spend twice as much time filling the round out. Sometimes they don't, and a failed round never looks good on paper. But then they're in the market again soon thereafter, and maybe they have to have a down round, which is a real negative, or even a flat round. So you don't want to be too ambitious with your pricing. On the other hand, you don't want to give away, as a founder, you don't want to give away your stock too cheaply. So it's a real balancing act. And I think the answer to that is you have to do a little bit of casual surveying among potential investors of what they think and listen to them. It's not what you want, it's what investors will fund.
It's a good point. Well, these rounds are almost never done by one investor. It's done through co-investing and syndication. What makes a co-investor valuable, and how do you collaborate with angels and VCs with your fund?
So a very good point. A lot of time, and I give this advice frequently to startups, it's always better on your cap table to have name brands, if you will, and not necessarily your relatives, initially. Obviously, money is money, and you need money from all sources, but it's really important to create a cap table where there's key opinion leaders or people that are recognized in the industry, or other venture capitalists or angels that have some renown within the ecosystem. And so I think that's really critical. As far as when you're doing a round, having a really strong lead is really significant. And that becomes maybe more important, or I would say definitely more important in subsequent rounds where there's more information out there. You can attract smarter money, etc. And a really good lead investor can bring along fellow investors much more quickly. And that's really the way to go if you can. So if you can attract a strong lead, definitely the way to go. And of course, we like to see grants that are on the cap table that supports attracting leads. If you have several different non-dilutive fundings from well-regarded institutions, et cetera, this can all help to attract a really solid lead. And if you can do it that way, that's absolutely the way to go. And we prefer to do it that way at Halo. We typically would not lead. Our investment amounts were not usually sufficient, but we would bring in fellow investors from one deal into the next deal if we thought it was a good fit. So some answers for you.
Great. Well, let's talk about Texas as an innovation ecosystem. What do you think Texas does especially well for startups?
Well, I think it's regional. I think Houston is really focused on life science. I think Austin is more focused on digital. I think Dallas is more focused on financial. But of course, there's plenty of exceptions to that, and it's, hardly definitive. In the life science area, Texas is outstanding, as is Houston. And to a large degree, it's related to the CPRIT program that's out of Austin. And then there's a new program, which I believe was voted in November, called NPRIT, which is going to be CPRIT, which is the Cancer Prevention Fund, state-run, that gives money to not a lot of prevention, but a lot of curative sides, cancer drugs, et cetera. NPRIT is supposed to do that with neurology. So that could be Alzheimer's or schizophrenia or something like this. And that's really positive because they have a solid stable of PhDs that triage these things before the state's money goes in. And so that to a degree is a stamp of approval that, as I mentioned previously, can support acquiring a deal lead or maybe even increasing valuation a little bit, that type of thing. So I think we do that well in life science. I think Austin does digital very well, very competitive, I think, with both coasts. The other areas, for example, consumer products or agricultural tech, I think we're less solid in, but those are some perspectives.
So for CPRIT, we see a number of founders coming by on a regular basis where they'd get a matching grant from CPRIT. You raise this from the angels, will match it up to this point. How do you evaluate those? Is that a sign of approval? Or does that make any difference to you?
Oh, I think it's a real positive. I mean, as I mentioned, the CPRIT stamp of approval is well regarded, and I don't think people mind being shaken down as long as you have a solid leader like that. And the matching money is really a very good way to go. You see it occasionally with venture capitalists. They'll say, well, we'll put in X amount of money, but you need to raise 500 or something like that. And so it's a tool that's used both by private and public funders, and I think it's positive.
So for Fund 4 that you just completed, what sectors were you leaning into? And which ones were you avoiding in that time frame? What's hot today and what's not?
Yeah, so Halo is a diversified fund. It's a committed capital fund. So we fund each fund in 3 tranches over 3 years, and the managing directors make the decision. As I mentioned, it's diversified geographically. It's diversified by sector. I talked about digital. I talked about life science and everything in between. But it's also, and this is important, it's also diversified by expected time to exit. So we have some that we expect to exit quickly and some that we expect to exit, at the end of the fund. And so that way you have, and the terminology that we compare it to is a bond ladder, where you have things that are going to mature at different periods of time over the 10-year, 12-year lifespan of the fund. And so that gets into fund design versus your own personal investments, et cetera. And there's some more complexity that goes into that we've learned over time. So,
So you see a lot of life science deals, and in the tech world, is revenue is kind of the main traction thing. But what are the red flags you see in the life science deals that come across the table that tells you there's going to be a challenge here?
well, that's a very good question. The first two filters I use when I'm looking at a deal is I say, does it improve patient health? And does it reduce cost to society? Because if it increases cost, it has more of an uphill battle. We have a cost containment mindset in medicine right now because costs are going out of control. And if you have something that increases costs, it needs to be significantly better than what's been on the market before for it to get any type of penetration at all. So a brand new cancer drug that cured a new type of cancer, well, cost containment's not going to be too concerned there. But if you're coming out with say you're coming out with a new weight loss GLP-1, well, there's already 3 on the market, it better be better, and it better be cheaper. And so those are some things I look at initially, but some red flags. A lot of times we get academics in this area, and academics, they betray themselves by using the word translation instead of commercialization. And it's a bit of a mindset difference to come out of academia, where really there's no time frame to get things done. And find the ultimate aspect of finance is time value of money. And so very much what we're concerned about in the venture world is time. And so that really is at odds with the historical academic mindset. So we need to make sure that these startup founders have fire in the belly, because otherwise this thing could take far too long. That's probably one of the red flags, and then there's the usual buzzwords you hear: coachability, know-it-all. And we have found that when we started this, we thought, well, a lot of these startups are really just PhDs newly minted who are trying to commercialize their thesis. We run into that a lot of times, and we're very concerned that these people did not have managerial experience. What we subsequently found was that they did not have managerial experience, but they were used to asking questions, taking advice, etc., because they had just come out of the student side of the academia world. And so we've not really had any issues with that, and actually has worked out quite well. We've had problems with, professors who have come out of the academic world and don't have a fire in the belly or a short time frame, etc. And that's, or they know it all, or don't take advice, not coachable. And so those are some things that we really try to triage for, because management is really the most important thing. Assuming there's a market and you can get something approved or get it on the market, management's really critical.
So we see a lot of pitch decks that are geared toward, technology innovation. This is great innovation here. And I think some investors see the path to that, to revenue and great exits and so forth. And other investors have a hard time seeing that. And then some will gear their pitch deck to be just a great business case. This is a moneymaker. It's going to do very well from that point of view. And then others will, again, position their deck as being, we're saving humanity. This person have a condition, we're saving them from that. How do you weigh how do you look at those 3 different positionings when you look at decks? What resonates with you best?
Well, one of the things we learned with Halo is that it's really difficult to have multiple objectives. So we have one objective at Halo, and that's return on investment. You can measure it different ways, but it's return. The thing that we run into is people who are trying to do multiple different things. So a fund that has multiple objectives, say return, but also they only invest in Nebraska, and they only invest in, male-oriented businesses or male founders, you just block yourself in. Now, what if there's a really good deal, next door in Iowa? You can't invest in that. So we at Halo, we wanted to have as few constraints and as many degrees of freedom as possible. But when I see people who have constrained themselves down, you can't be maximizing your return by also maximizing all these other things, right? And so you want to look at the person's objective. Is their objective to save the world and profits be damned? Well, that's obviously a huge red flag. Now, if we can make huge profits and save the world as a secondary thing, that's wonderful. I think that's great. And so you're looking to see how conflicted they are between multiple objectives or a single objective. And you see that sometimes in the college world, where the students, business plan competitions, et cetera, they're out to save the world, et cetera. And I think that's all very good. There's repeating themes in that area. For example, antibiotic resistance. I see that, several times a year for the last 10 years. And there's other examples, but I hope I've answered your question.
No, that's a great answer. Very clarifying. So in the last few minutes that we have here today, what else should we cover that we haven't?
We would love to put together a Halo 5, but we would need some investors, or if somebody is interested in a white label fund, we have the capabilities here to do that.
All right.
So be very interested in talking to anybody who is interested in putting together a small super angel type of fund. 19 years experience working in this area. I think I can help them.
Great. So how best for listeners to get back in touch with you?
Well, Rob.Tucci, Tucci at TexasHaloFund.com.
Great. Well, we'll put all your contact details in the show notes. I want to thank you for joining us today, and we hope to have you back for a follow-up soon.
Very good. Thank you for the invitation. Have a great day.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.